Welcome back. Market still very, very dibbly-dobbly. At this point in time, all the indices are mildly in the red. So watch out. It's not able to hold at that 8,200 levels at this point in time at Friday's lows at this juncture. But not a whole lot lost. So what's for the medium term? I caught up with Surendra Goyal of Citi. He's the head of research at Citi, ahead of Citi's annual India Investor Conference that kicks off today. I began by asking him what is the view on the market and how they expect earnings to pan out in FY17. Listen in.
Earnings has been pretty decent for the fourth quarter. Okay, the overall headline earnings may look muted, but if you kind of take out financials where we have seen a big impact of provisioning, earnings have actually surprised positively. If you look at the BSE Sensex, earnings ex financials, the growth is high teens. Okay, versus an expectation of single digits. So that's a material beat. Okay, and if you kind of look at it in another way, if you look at the BSE 100 companies, 47 of them have exceeded estimates. 41 of them have missed, but I think 47, 41 is a fairly decent ratio to have, given the kind of trends we have seen in the last couple of years. Okay. Another metric, if you look at, is the downgrade-upgrade ratios. Okay. So it's right now upgrade-downgrade is 40-60, and this has been improving through the course of this year. Okay, so I think if you put it all together, we have had a decent earnings season. And what is interesting is FY17 earnings are by and large unchanged. Okay, which is interesting if you kind of consider that on the financial side, we have had fairly significant downgrades. So the rest of the sectors are kind of contributing and essentially offsetting the impact that we have seen on financials. So at an aggregate level, we have seen decent earnings. From a FY17 perspective, our expectation is for 14% odd earnings growth on the Sensex. Okay. Okay.
Now, what does that do to your index target in that case?
So our index target, we have revised it up from 27,000 to 28,800. And the change is primarily we are seeing a good earnings momentum. And also on the multiple side, we have raised it a notch, a very small change. But I think what is interesting and which we have highlighted in our note is whenever earnings momentum has been positive, the market tends to trade at higher than mean kind of valuations. Right now, the mean last 10-year mean is say 15 and a half times. Our target is at 16 times. So it's not a significantly higher multiple. But I think if the momentum trajectory continues, higher multiples cannot be ruled out.
Okay, so this 28,800, 29,000 Sensex, which are the horses that lead from the front?
Yeah, okay. So from a earnings perspective, if you look at it, what we are expecting is some of the sectors which had a tough FY16, like financials, materials, etc., they see a significant rebound. Okay, and it's largely base effect, and things seem to be improving a little on the material side. Even on the financials, the underlying is pretty decent. Autos and pharma, etc., these are sectors which have been doing well. We expect the momentum to continue. Okay, so I think it's a combination of a lot of these things coming together, which should drive the 14% earnings growth next year.
Okay. Is there anything that you would avoid? I thought you have got an underweight on some sectors like consumer.
Yeah. So consumer staples, we do have a underweight. Now, there are a few things to keep in mind here. Firstly, if you look at volume growth for a lot of the players, they are mid to high single digits. Okay. And valuation multiples of the stocks are extremely rich. So I think that's something which one needs to keep in mind, that unless volume growth picks up significantly, these multiples may not be easy to justify. And the second thing is obviously the impact of Patanjali, which we have highlighted in one of our reports as well. What it does to the sector is, firstly, they are taking some volume share in multiple categories. So the volume growth of the incumbents is getting impacted, and it also impacts your pricing power. If there is so much competitive intensity, you may not be able to take price increases, and that's the reason why we have an underweight on consumer staples.
Okay. A more broader question on the numbers. This earnings season, what stood out was EBITDA growth and EBITDA margins, not so much revenues and even less volumes. What do you think will be the trajectory for FY17? Will revenues take over and EBITDA decline?
So what we are expecting is that revenues see a significant uptick. Okay, this year is actually on the headline level negative. It's a decline. So we are expecting that that turns into positive. Okay, and what also happens is the moment you have revenues growing, okay, and this year was a year of contraction, you will have some operating leverage kicking in. So while I take the point, and that's a question I get very often, that this year was a year of commodity price benefits, next year they may not be there.
Exactly.
But I think operating leverage kicks in. Okay, because your revenues are starting to grow. And secondly, corporates also are in cost control mode. A lot of sectors have gone through difficult times and people have been tightening belts. So that impact should also come in. So you will have a mix of revenue starting to grow faster and EBITDA margins kicking in.
Okay, we will have more of that conversation played out to you through the day. And tomorrow, of course, from the Citi Investor Conference, we will have more guests joining us as we wind down on Bazaar.